Welcome back. This is Chart Overload. I'm Ryan Mumy. This is Sollinda Capital Management. With me, Justin Greenhill, our Chief Investment Officer. Chart Overload again, where we a couple times a month go through charts that we find interesting, that we think maybe the mainstream media or the data overload that's being dumped on the intrawebs isn't necessarily covering or talking about. Yeah, we hope you enjoy it. So let's jump right in. First thing, big picture. We showed this last time, and it's the release of a guy from New York Times book on 1929, the Great Depression, and the day he rang the bell stands to is the top in the market, Justin.
Ringing the bell. Yeah. If this does, in fact, prove to be the top for some time, the contrarian indicator was truly classic. So we shall see.
Yeah, right. We will. Moving on to the next chart, takes a look at annual finances, looking at debt to earnings. Again, not anything you can necessarily trade on, but it's something to pay attention to.
Yeah, in particular, this is kind of connected to this is at the epicenter, I should say, of the worry that's cropped up in the market. This is Oracle Corporation. This is their net debt, which is the orange line, and the black line is their earnings. So, needless to say, they're levered up on AI.
Hashtag all in.
Which, interesting to note, founder Larry Ellison still yet owns 40% of that company. So, I mean, he may know something we don't know. He may have a policy backstop.
Well, he's also got access to capital that we probably can't even imagine, but that's neither here nor there.
And he's got the ear of Mr. Trump.
Yes, that is a Roger. Moving on to the next one. This is an interesting chart again. Our buddy Keith, our chief market strategist, shared this with us from Wells Fargo and Bloomberg. Looks that households now have their ownership of equities has exceeded their ownership of real estate.
Which is pretty remarkable when you consider that real estate prices have also gone up a lot in the last several years. It just goes to show that the domestic equity market is really the core component of savings for the whole population.
Again, this isn't something you can trade upon, but it's definitely something to keep in the back of your heads. Next chart looks at allocation to stocks and commodities from Bank of America. And again, it just shows that, again, we've said it many times, hashtag all in. There's lots of data to support that I guess what we joke about, but it's true.
Yeah, so on this chart, the dark blue line is just, as you said, the measured allocation to stocks and commodities. The light blue line is the ISM PMI, which is basically a sentiment survey of factory owners and business owners' expectations for the economy. And notably, the stock market has diverged on the upside from that. So either that means that this sentiment amongst manufacturing should set to pick up, or it just means that people are all in and there's a chronic pessimism or uncertainty, which a lot of that could have to do with the tariffs as well. So,
yeah, I mean, again, and there's some big news expected at least in the next month from the Supreme Court on that front. And again, what happens on the other side of that, who knows? But the ISM manufacturing Purchase Managers Index relating to manufacturing has been depressed for some time, and we'll see. Moving on to the next chart, it's from Jim Stack's company Investec. They put this out, and I thought it was great. It looks underneath the employment report and looks at employed part-time for economic reasons, and as they point out, that has jumped. The question is it because of the government shutdown, or this is just a blip in time, or is it something under the surface?
The interesting thing about this chart too is I do believe this does not count for gig economy jobs like Uber, and if it did, this would actually have moved up even higher.
Yeah, a ton. That we've talked about the labor market often as we have to pay attention to it, and the K-shaped economy, but you've got quits down. People are quitting their jobs much less, and you've got job openings actually surprised to the upside. So there's there's a lot of divergence even within in the subcategories of how is unemployment or the labor market as a whole. But again, it bears watching. Next chart again, looking at private payrolls from the ADP report. It's shows that small companies, big companies are creating their own little K-shape.
Yeah, so small companies getting rid of jobs, firing people, aka, and medium-sized companies, large companies, a little bit less so, and just the divergence between the stock market, the biggest of big companies, and what's happening in the overall granular economy is just seemingly more divergent by the day.
And the question is, does that turn into some growing unrest where voters, vote differently, and all of a sudden there's a shift to some of these large monopolistic type companies come under some government pressure because as of now they have not. Um, Moving into domestic stocks, this chart looks at the Magnificent Seven index, and it similar to the first chart we showed where Mr. Sorkin may have at least temporarily rang the top on the equity markets. Mag 7 has been down from its October record over the same time frame.
What's really important to think about going forward when one thinks about the so-called Mag 7 is for the past 10 years or so, these have been companies that have been characterized by huge margins, very little capex because they've had the network effect of their platform and just massive free cash flow. Versus now, even if you are a big believer in AI, these are no longer companies with that profile. These are companies with huge expenditures and much less free cash flow at best.
Yeah, and we've talked about this repeatedly. At some point investors are going to demand an ROI, right? And are they starting to? I don't know. We'll know in hindsight, but the data is the data, and they are spending a significant amount more than they have been in the past. And as you said, they have less cash flow, free cash flow. Next chart looks at the correlation of the market cap S&P and its equal weight brethren, and that's been on an interesting ride the last, what is that?
Really, since the
30
pandemic. I mean,
years.
it's yeah. So basically, you've just got a situation where in a trailing 3-month period, day over day, oftentimes the equal weight S&P and the market cap weight either don't move in lockstep or, we've seen here recently on display, move in opposite directions, which just goes to show the degree in which the biggest of big companies actually drive the market cap index. And increasingly, the S&P 500 market cap is not really a reflection of the whole stock market.
Yeah, it's what 40% in 10 or 11 companies of the 500, and yeah, which again is not, I hope, isn't news to anyone that's graced us with their presence in past chart overloads. Next chart again looks at the ratio of equal weight to S&P 500, and obviously moving down, that's the market cap, traditional S&P 500 outperforming, and recently there's been a little jump in the opposite direction.
Yeah, so I mean, this has been a tough one to call, but if you were to look at this chart and let's assume that the equal weight S&P does in fact find a relative bottom here and go on to outperform, one would be able to say in hindsight it was long overdue.
Right, and this is similar to the chart we showed. I think it was like in January. We showed it in January and February of the S&P 500 to small caps,
Yeah.
which are our
Even more
whole point.
extreme, right? Even more extreme.
Yeah, and even coming out of the tariffs was, if the bull market has legs, there had to be some broadening in participation, which we've started to see in the end of the third and the fourth quarter. Next chart looks at just industrials, the industrial sector, large cap, small cap, and they've had a nice run here recently.
Yeah, so I mean, industrials are, what they imply, the industrial economy. But what's interesting is the kind of sub profile of the industrial sector is much different in that the type of industry that's being built out right now is, again, kind of back focused on the whole AI play. So there's been a lot happening under the surface, but, big picture, just as the mega caps are starting to potentially not make new highs or roll over, this is an area of the market that is making new highs.
Last chart in domestic markets looks at the volatility index. Obviously, there's been some big spikes there that everybody can probably remember, but today we're fairly neutral.
Yeah, this just goes to show that, if the market doesn't start to move here, potentially you could say volatility is relatively high. But at the same time, if the market really does start to move, obviously volatility as measured by the VIX could still go up a lot. So we're kind of in an interesting middle ground there relative to history.
Moving on to non-U.S. markets. First chart looks at the U.S. dollar going back to 2019, so 6-year look back, and there were some newspaper or news magazine articles talking about the king dollar that might have, or at least have since then, marked the top in it.
Yeah, it's really quite incredible how, even though it seems so obvious and would seem too easy, because obviously it doesn't work all the time, but oftentimes, surprisingly often, there are huge behavioral indicators at, market tops and bottoms. And at least for now, that certainly nailed it.
Yeah. And the dollar is, while the administration may say they want a strong dollar, their policies would disagree. Their policies weaken the dollar. Moving on to Chinese stocks, they've outperformed other global equities so far this year.
We mentioned Korean stocks last time and talked about how, as sort of a proxy to the semiconductor play, they did really well. And this just exhibits the degree to which Chinese stocks, which are also largely dominated by big tech companies, Alibaba, Tencent, and so on, have pulled back recently, but had a big year. And the Chinese government, I don't know if you saw this, but they came out here, I think it was a few days ago, and have talked about even more so how they're looking to channel the wealth of the country from the real estate market and into the stock market. Because, in the real estate market, when wealth concentrates there and prices go high, it's bad for the population. But they're probably envious of the US model, which is all into the stock market.
Speaking of the Chinese property market, this next chart looks at there's been some issues there, and there's been some issues there for some time.
This just shows it, right? So, major cities, non-major cities, property prices have been really steeply declining for a few years now, and it's not that that is only market forces doing that. That's been very much a policy thing in an attempt to kind of drive speculation out and create some more affordability. Because, as we're kind of seeing here in certain areas of the U.S., when housing gets unaffordable, politics tend to change, and the Chinese Communist Party is not about that action.
Oh, they, they do not. Um, yeah, and closing out non-U.S. stocks, shift gears to Latin America. Um, Brazil central bank obviously hasn't cut rates, and they've maintained a really high policy rate.
Yeah, so even though this is restrictive for the economy, I mean, these real interest rates are close to 10%. So that's basically take your interest rate minus inflation, and you've got, 10%, which is some of the highest in the world. And that's been supportive of the currency and great to receive that fixed income. But we'll see what happens if and when they're able to actually start cutting rates and how far they're able to go. What's interesting about this country is they'll have rates at 15%, but if you remember in the wake of the pandemic, they got them all the way down to 4%. So, I mean, imagine the returns that you're making receiving 15% and riding a bond all the way down to 4% yield within 2 years. Now, again, we're not calling for 4%, but could they go to 7, 8, or 9 there? Assuming that global inflation doesn't pick up and oil prices stay low, perhaps.
Next chart just looks at the Brazilian ETF that trades here domestically, EWC, and it had a good year as well.
Good year. Recently got a pullback, as expected. Presidential election coming, so there is some kind of reflexive headlines going on there in terms of the center right has yet to really crown a contender to who is incumbent left president. And at the same time, December is a month where a lot of the companies in Brazil pay out their dividends to investors abroad. So you've had really two things kind of weighing on the market and weighing on the currency this month so
Yeah, I
far.
think I saw where EWZ's annual dividends like 6 or 7%, I believe, this year, which is pretty remarkable and not similar to how the U.S. companies, I guess,
And
would
if you look at
operate.
their oil company, Petrobras, they had a dividend of what, 14, 15%, just simply because it has to compete with the risk free rate.
Yep. Moving on to interest rates, the bond market. This first chart looks at the spread between the 2 and the 30-year yields, and it was negative for a historic amount of time, and it's not anymore, and it's actually steepened quite a bit.
Yeah. What is interesting about this is the last time it was this steep, the short-term rates were much, much lower. So we've got a situation here where not only are policy rates still not that low relative to 10-year or so history, but you've got longer term rates carrying a premium, and that premium could go higher. So we will see if that disrupts sort of the status quo in stock markets. Traditionally, you would think higher 10-year rates, lower multiples on stocks because there's a competition mechanism between bonds and stocks for capital. But as you and I were talking about offline earlier, Ryan, that mechanism might be a little bit more difficult to flow back and forth between those two now than it was, because there's a constant negative narrative about bonds and there's a perpetually systemic support for stocks.
Yeah, and again, all we can do is continue to monitor the data. Next graphic looks at J.P. Morgan's Treasury client positioning, and I think the hashtag all in applies here too.
So, what I think this probably says is that if longer duration bond yields start to move higher, especially with more volatility, there's going to be quite a bit of investors caught off sides, because it appears that people have really crowded in the bond market because of rate cuts. And, if that starts to get paused, or, inflation comes back, it could be a pretty volatile year in the bond market.
Yeah, but it hasn't been. We've talked about it in our other commentary that the despite spreads being so tight, um, the the move index that tracks volatility of the bond market has not increased. It stayed really depressed.
Yeah, if a macro hedge fund were to, take a risk reward bet, being long volatility in bonds into next year would probably be pretty asymmetric. Lose a little and maybe make a lot.
Maybe. Last section looks at commodities. First chart looks at a just comparison of gold's price action versus that of copper.
Gold, typically in commodity markets, what's interesting is they often are very similar. And gold often kind of starts, and then the more cyclical commodities kind of follow. So we've seen copper uh, perform very strongly earlier in the year, have a massive correction, and now it's kind of moving back the other way. But at the same time, I'm going to be the one to segue here to the next chart. To the next chart, both pale in comparison to what silver has done.
Yeah, it's from the guy we like reading what he has to say, Brent Donnelly. He put this out that silver has had multiple 1 year rallies that exceeded 100%. And as I mentioned to Justin, is I don't think the industrial use of silver has went up that much. I believe there's some speculative pockets of money that are chasing that.
You don't think the whole world's moving to wind turbines?
Yeah, I don't believe so. Man, maybe I missed it. I don't know. But yeah, it's just something to pay attention to, and if you've been lucky enough to have some exposure there, you might.
Just one more point to add. Some of these things, when you look at these smaller markets like silver, or it could be some of the miners, or just basically any area of the market that's not your mega cap tech companies, even though a lot of these areas are up, 100% or more this year, they are still very, very, very tiny compared to the market cap of the 10 biggest domestic stocks. So you kind of have to look at those two things as sort of contrary to one another. On the one hand, it's difficult to chase things that are up a lot, but on the other hand, if investor capital globally starts to want to prefer other things than just the 10 biggest US companies, there's plenty more money that could go everywhere else.
Yep. And what I was going to say is one of my favorite sayings is no one's ever went broke taking a profit, so
Emotionally
just,
broke, but yes.
yeah, watch your exposures. And last chart looks at oil. We talked about it being very range bound, and here recently it's broken down.
So oil just cannot get moving in the right direction for anything, which for the economy, for the consumer, and for the case of ongoing interest rate cuts, that's a very positive thing. But at the same time, this is something that you mentioned the other day, Ryan. At what point does oil continuing lower start to indicate even more economic weakness than we've already started to see? So probably not there yet, but what's really fascinating is last time oil was at these levels, interest rates globally were much, 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 much lower.
Yeah, yeah. Again, it's like there's no like there's you can't trade on this per se in our world for clients or advisor partners, but it's something you have to pay attention to and be aware of, and that way it doesn't shock you when something spills out from it. Because the oil market, no matter what anyone would want to tell you, is still a big part of the global economy, and it is a big input to a lot of other things. And as such, when it goes down a ton or goes up a ton, it it has spillover
Typically,
and
over time, on a rate of change basis, you'll see interest rates move with oil simply because oil's the key, variable in inflation that actually trades and moves. But if you look at what's happened recently, there's a huge divergence between interest rates, especially like let's say on the 10-year, which are, down from their multi-decade highs, but are still really high relative to like a 15-year history. And oil is back to where it was in 2016, 17, 18. So if one were to want to explain that, the answer would probably be that there is perception that there's a lot more debt out there, and at any moment, any government or all governments could do even more stimulus, right? Which would be more debt and more of a inflationary impulse. So we're kind of seeing in the developed world and in the US what you see in reflecting back to the Brazil interest rate chart. Real interest rates have to be there to buffer for excess government spending.
developed becomes emerging. We shall see. This is our last one before Christmas. We hope everybody has a magnificent Christmas with their families, and a happy New Year. We appreciate you spending time with us, listening to us ramble on about our thoughts on the markets and various charts out there. We'll be back next time. If you want to get in touch with us, info@sollinda.com, info@sollinda.com. Shoot us a message, and we're happy to chat on whatever topic you want. But again, we'll see you next time.
Merry Christmas.